Jim, one of the things that I think everybody in this room was quite aware of is the impact of the financial crisis in North America, but also worldwide. I think sometimes we forget the severe impact it had in the United States. We don't go through a situation in this country where we see people, our next door neighbors, that have foreclosure signs on their front lawn. I think we're all now coming to grips with the magnitude of the repercussions of that. But, one of the things we have to say is no pension fund reacted better and stood stronger during that process than HOOPP did. And I know you're a modest person, but I'd really love you to talk a little bit about what went on during that period of time and what the lessons learned were for you during that period of time, because it was really quite remarkable how well HOOPP stood up during that period of time, and especially considering your governance structure with both labor and management at the table. So wouldn't mind if you talk a little bit about that time.
Sure. We started on the path. So HOOPP is well known globally for our approach to investing, which we describe as liability-driven investing. So it's, which really is a risk management strategy. And that all started out of the tech meltdown we saw in 2000, 2002. And we had, at that time, we had a severe decline in equity, so our assets went down in value, and we also had a big decline in interest rates, which caused our liabilities to go up in value, or the present value of our liabilities to go up in value. So we went very quickly from having a surplus to a deficit, and so when we did a postmortem on that, we looked at it and we found that the risk between most of the risks that created that problem was mismatch between assets and liabilities. And at that time, it was kind of accepted in the pension world that that's just what it was, and that you kind of invested half your money, 60% of your money in stocks and 40% in bonds, and everything was going to work out fine. Which, if you stress test that, you find that's actually not correct. So we then tried to think about how we could restructure the portfolio to better match assets to liabilities and reduce that risk. So we essentially created a different portfolio structure, which was liability matching portfolio, which essentially contains a bunch of assets that act like our liabilities, which are essentially interest rate sensitive assets and inflation sensitive assets. And then we overlaid that with a whole bunch of derivative strategies, which gave us additional return that allowed us to meet our objectives. So we actually had that took place over about a 5-year period, and we actually implemented that in December 2007, which was fortuitous, but it's we weren't trying to be market timers, but it was driven by the right motivations, which was to try and control risk. And we recognized that the sort of three factors that can take a plan down, or your funding stats down, which is a decline in long-term interest rates, decline in equity markets, and an unexpected rise in inflation. And we've actually seen two of those big risks play out over that period of time. So when we had in December 2007, we actually took 30% of our money out of equities and redeployed that money into real estate, which is an inflation-sensitive asset, and to long-term bonds and real return bonds. So so the next year, actually, when they it was funny, I mused to our board at the time that we're going to look very different from everybody else, so maybe it'd be good for us to have a decline in equity markets next year, so we look good. So I guess the message is be careful what you ask for, but wish for. So I wasn't expecting a 2008 situation, but in any case, we actually withstood that crisis very well, and liquidity management is something we focus a lot on because of our use of derivatives, and so we have a very liquid portfolio at the time. So actually, 2008 actually was kind of played into our hands in the sense that we had a lot of liquidity, and we're very long-term investors. We have a very long-term time horizons, 50 to 70 years. And the best time for us to buy long-term assets is when they're on sale, which is like they were in 2008. So we had liquidity, so we were able to be on the right side of that transaction. Rather than being a seller, we were a buyer. And so that actually benefited us for quite a period of time after. But I think the whole message is that it really is driven by risk management and understanding what the risks are within pension plans, and positioning yourself in a way that's you're going to control those catastrophic risks and try and take other risks that are not catastrophic.
That's great. Thank you.